Welcome to Chapter 5, Financial Forecasting. Financial forecasting is closely related to another area that managers are oftentimes involved with. Budgeting is something that most departmental and area managers have to deal with on an annual basis. So Chapter 5 gives us just a little bit of insight on how that process can take place and the interrelationship between budgeting and actual financial forecasting. Usually the financial forecasting and the budgeting coincide with one another. Let's start with Elvis Products and the income statement from 2011. The first thing that we want to do is to change the name of our income statement and call this a pro forma income statement because it is a projected income statement. Now let's go ahead and grab column B, right click, and click Insert. Let's go ahead and type in 2012. Okay, let's go ahead and center those columns, and let's just go ahead and size these columns down to grab all of column B, C, and D and size them all to a similar width. Now to indicate that 2012 is a projected number, let's go ahead and right click, click Insert. Let's try that again. Go ahead, right click on the year of 2012, click on Format Cells, click on Custom, click on the 0, and next to the 0, go ahead and type in quote, asterisk, and end quote, and hit enter. So now the 2012 is showing up with an asterisk after it. Now our demonstration problem starts off with a projected level of sales of $43 million. Okay, and let's go ahead and add the comma formatting to that of 4,300,000. In addition to that, so that we're consistent with the demonstration problem on page 145, let's go ahead and reformat our income statement to reduce the number of zeros. So once again, click on Format Cells, click on Custom. Now let's go ahead and click on the hashtag 0.00, and up in here go ahead and type a comma in and then click OK. And so now we're rounding off to the 1,000th place. Now let's go back up into the pro forma income statement and let's go ahead and indicate this is in thousands. Okay, now notice that this is the pro forma income statement for the year of 2012. Let's go ahead and change that as well. I know this is a little bit different than what our authors are showing, but it is a little bit more accurate and probably a better way to do it. Now the method that we're going to use for projecting the income statement is called the percentage of sales method. The percentage of sales method is premised on the concept that certain accounts have a specific relationship with sales. So as sales moves from 3.8 million to 4.3 million, other accounts are also going to have a corresponding increase. And so in this case, let's go ahead and copy and paste the years of 2011 and 2010. Now, let's go ahead and say for the cost of sales for 2011 equals the cost of goods sold divided by the amount of sales. Let's go ahead and click on the F4 button 2 times to get the referencing at just in front of the 5 and hit return. Let's go ahead and copy that over to the year of 2010, and now let's change that into a percent with 1 decimal point. So what we've accomplished here is we are saying that in the year of 2011, cost of goods sold was 84.4% of sales. So therefore, percentage of sales. Cost of goods sold represented as a percentage of sales. In the year 2010, the cost of goods sold was 83.4% of total sales. Now then, to actually use that as the projected amount, we're going to take the average of these two percentages over the 2-year period and multiply that by the projected level of sales. So let's do it. We're going to click on to the FX button, and here I have average, or you can type in average 2 times and hit return. Now, once you do that, go ahead and highlight the cost of goods sold for the 2 years and hit return and click OK. Now notice that it's showing up as 0.00. We still need, now that is the average of those two items, but let's go ahead and multiply that by the projected level of sales. And so we can see that cost of goods sold is supposed to be projected at $3,609,000, which is equal to the average of the cost of goods sold based on the last 2 years, as a average of the cost of goods sold as a percentage of sales. Okay, that one may be one that you need to contemplate for a little bit to figure out exactly how that plays out. Now let's go ahead and copy the formatting from the year of 2011. I'm going to just use the format painter. Okay, so we have our formatting. Now notice that we have a formula in the gross profit. We can just copy that formula over to 2012. Next, we're going to make the assumption that the selling, general, and administrative expenses also have this same relationship with sales that cost of goods sold did. So if we created our formulas correctly, we can just copy these formulas and paste them down below. And now let's go ahead and do this again, rather than just copying the formulas, just so we can get one more exposure to how this is working. Let's say equals the selling, general, and administrative expenses divided by sales, percent of sales. And click on the F4 button 2 times to get our referencing right. Now we can copy that over. Now we're going to take the average of those two and multiply it by the level of sales for the year. Average. Click on to the icon there on the right. Highlight the 2, hit return. Now come back in and say multiplied by the level of sales for 2012. And there, our projected level of selling, general, and administrative expenses is $334,000. Our fixed expenses and depreciation expenses, according to the problem, at least fixed expenses is expected to be the same. The depreciation expense, however, is going to be equal to the $20,000 from the previous year, and it sounds like the company is projected to buy some additional equipment, which is going to create some additional depreciation. So down here underneath the tax rate, let's type in additional depreciation. And the additional depreciation is going to be $5,000. Okay, and go ahead and use your format painter from above to create the 5.00. So therefore, our depreciation expense for this year is going to be equal to the $20,000 from the previous year plus the additional depreciation of $5,000 for this year to get to $25,000. Now the earnings before interest and taxes, our formula is already in there, so we can just go ahead and copy that over. Next, we have the interest expense. For right now, let's just type in $76,000, but this is one that we're going to come back to after a little bit. Now, our earnings before interest and tax, earnings before taxes formula is in. Go ahead and copy that over. Our taxes are going to be equal to the earnings before taxes multiplied by the tax rate of 40%. And hit enter. And then finally the net income, copy that over, and our formula is working. So here we have the projected income statement for the year of 2012. Once again, one of the key items to this method of projecting is understanding that sales has that key relationship with various accounts on the financial statements, and we're using that relationship to project the level of those particular accounts. One other thing that I forgot to mention is that as with most projections, especially with projecting the income statement and balance sheet, it really starts off with projecting sales. We always need to project sales first in creating this type of budgeting process. Okay, let's continue on to the balance sheet. Let's do the same thing that we did on the income statement. If you grab column B, highlight all of column B, right click and click Insert. Now, once again, let's type in 2012, and let's narrow that column down. Excuse me. Right click and Format Cells, Custom, 0, in parentheses, the asterisk, and hit Enter. Okay, and once again, I think it looks a little bit better if the years are centered, so go ahead and center the years. Now, the cash and equivalents, some accounts have that relationship with sales, some accounts do not. Cash and equivalents, this would come from the cash budget. In this case, we don't have the cash budget. We're just going to assume that the cash and equivalents is going to stay relatively constant. So let's just go ahead and type in $52,000. Okay, once again, let's go ahead and highlight the 2011 data. Grab your Format Painter and hit the 2012. And then, once again, we need to round to the thousands. So let's go ahead and do that. Format Cells, Custom, and the hashtag 0.00. And then once again, put the comma after the last 0 and hit Enter. Now we're rounding to thousands. Let's go ahead. Once again, we need to identify this as the pro forma. The pro forma balance sheet for the year of 2012. Okay, good. Next, once again, we're going to identify the accounts of which have that strategic relationship with sales. Copy and paste the years. Now, cash does not have that relationship with sales. However, in this case, our authors are assuming that accounts receivable and inventory do have that relationship with sales. So let's go ahead and first take the 2011 accounts receivable equals 2011 accounts receivable divided by, click on to the income statement, the 2011 sales. Okay, before you click Enter, once again remember to hit the F4 key 2 times and getting the referencing right and $ right in front of the 5 and hit Return. Now let's go ahead and change that to the percent, maybe with 1 decimal point, and copy that over. Now we're going to use the same logic once again. We're going to take the average of these 2 years, and hit Enter, and then we're going to multiply that average by the projected level of sales and hit Enter. Okay, so once again, just kind of in review, we're taking the average of the percentage of sales, and we're multiplying that by the projected level of sales for the year of 2010. And let's see. Oh, I'm on the wrong item. We're projecting that by, here it is, the projected, or multiplying by the projected level of sales. Okay, now we're going to assume that inventory also has this same relationship. So we can, once again, take the average. I'm not sure. I think, oh, I got an extra item in there. There we go. And I'm going to multiply that average by the projected level of sales on the income statement. And hit enter. Okay, so now we have in 2011 total current assets is already formulated, so we can just copy that over. Now in our example in our textbook here, it appears that we have net additions. If you look all the way down, and I'm looking at page 153, but on line 29 we're going to say, or excuse me, line 28, we have notes. And in the notes we have net additions to plant and equipment of 50,000. Okay, and so go ahead and grab any item from the worksheet above, grab the format painter and copy the format painting on down. We're going to say the life of new equipment in years is 10. And so we have new depreciation. Assuming the straight line of 5,000. And once again, grabbing the format painter. Now, one of the things to keep in mind here is that projecting the depreciation in this way is not typical. Most businesses, or a lot of businesses, have financial software, specifically depreciation software, that will project the depreciation for you. So in projecting depreciation, of course, you need to identify any additions to plant and equipment of which might be expected, and then you would let the software, you would enter that net additions, but then you would let the software take over and project the depreciation for you. So in this case, our plant and equipment is going to be equal to the prior year's plant and equipment plus the net additions to plant and equipment of 50,000. So our plant and equipment is going to be $577,000. Our depreciation is going to be equal to, now notice that if our existing equipment continues to depreciate at the same rate, well, the difference between the 166 and the 146, you can see that that's $20,000. So if our existing depreciation continues at $20,000, our next year's depreciation is going to be the 166 plus the difference, or the $20,000 that we just talked about, plus the additional depreciation that we calculated down here. So, and once again, this is something that software normally does for us, but let's go ahead and do this. We're going to say the $166,200 plus, in parentheses, the 166 minus the 146 in parentheses. So that means the 166 plus the 20 plus the $5,000 new depreciation on the new equipment. And hit enter. Our accumulated depreciation is estimated at $191,200. Now we can copy over the net fixed assets formula, and we can copy over the total fixed assets formula as well. Continuing on, the accounts payable is estimated as having that same relationship with sales. So now that we've done it a few times, we can just go ahead and copy and paste the formula down here to get the percentage. And then if you would like, we can copy this form. Now if we're going to copy the formula that we did up here, we better put some referencing around our cell indicator. So I'm going to do that. Just click on the F4 button, hit return, and then right click and copy and paste. And so our accounts payable is estimated at $189,000. Continuing on, that the short-term notes payable is not going to have the same relationship with sales. So some accounts do have that relationship, others don't. In this case, we're just going to use the same amount as we had last year. However, our authors are saying that the other current liabilities would likely have the same relationship. So let's go ahead and copy and paste our formula. And we can copy and paste our formula again. Problem there is now the formatting went away or just a little bit, so grab your format painter and paste it over. Okay, so what did we accomplish? We took the average, as is average of those two items, and we're multiplying it by the projected level of sales. Okay, we can copy over our formula for total current liabilities. Long-term debt, now in this case, let's just go ahead and enter the $465,610 and hit enter. This is one that we're going to come back to. I'm even going to highlight that one in green just because that's going to be an important one for us coming up. But in the meantime, let's go back and copy over total liabilities. Let's copy over common stock because that's not those two, or excuse me, common stock is not likely to change unless the company sells some more stock. Retained earnings. Now, retained earnings is a factor of, remembering, retained earnings, prior year retained earnings, plus this year's net income minus any dividends. Before we make the calculation, let's click on to the statement of cash flows. That's one place where we would be able to find cash dividends paid to shareholders. In this case, it's not identified, so let's go ahead and type in 22,000 because that is the amount that our authors used in this original problem. Now we can go back to the balance sheet and project our retained earnings. So once again, click on to the statement of cash flows, enter in $22,000 because that's the assumption that is being made with this particular problem. Now going back to the balance sheet, we can say retained earnings is equal to the previous year's retained earnings plus, click on to the income statement, this year's net income minus, click on to the statement of cash flows and subtract out the 22,000 and hit enter. Our retained earnings is estimated at $297,000. And then we can just copy over our two formulas for the shareholder equity and total liabilities and owner's equity. Now, we're not quite finished yet. Notice that on our balance sheet we have a little bit of a problem. Notice that our total assets does not equal total liabilities and owner's equity. And when looking at this, in order to fix this, we need to go through a little bit of a process. Remembering back onto the income statement, we just kind of threw in interest expense. But we know that interest expense is actually a factor of interest rates and a factor of the amount of debt and the amount of short-term versus long-term debt. Now, in order to fix this problem here on our spreadsheet, let's make a quick assumption. Let's just say that we're going to, for simplicity's sake, we're going to have and average interest rate, which is the average for both long and short-term debt. Once again, that's not really realistic, but just in this case, I think it will serve the purpose. So let's type in average interest rate. Okay? And so therefore, the actual interest expense, or the estimated interest expense, is going to be a factor of the average interest rate. In this case, let's assume an 11% interest rate. If you haven't done so already, go ahead and create the interest formatting with 2 decimal points. Now let's say the interest expense is going to be equal to the interest rate multiplied by the level of debt. So let's use the the parenthesis. Click onto the balance sheet. Click on short-term notes payable plus the long-term debt, and close the parentheses. Now you can see our interest expense is estimated at roughly $76,000. Now let's go back to the balance sheet. By the way, just to let you know, this is going to cause a little bit of a problem here, because as the level of debt changes, so does the level of net income, because as debt goes up, the interest expense goes up, which then on the balance sheet, as interest expense goes up, it causes retained earnings to go down, causes net income to go down, and retained earnings to go down. And let's talk about one other aspect here before we continue. Notice on page 148 and 149, our authors discuss a couple items called, at the top of page 148, something that's called spontaneous sources of financing. Imagine doing business and there's ways to finance that just automatically appear. Well, an example of spontaneous financing would be in accounts payable. As the level of activity for a business picks up, so does the purchases or the purchasing of inventory. As inventory purchases pick up, so too will accounts payable. Accounts payable is an excellent example of spontaneous financing. It's financing that just almost kind of takes care of itself. However, the other type of financing is called discretionary financing. Discretionary financing takes a specific effort to coordinate and arrange for the financing. In this case, short-term notes payable is likely to be a source of discretionary financing, as is long-term debt. You have to take specific courses of action to make sure that you have this financing in place. So notice here that in our example that we've looked at so far, that we just assumed we took $46,561 and made it an assumption that just kind of threw it in there, which almost makes our balance sheet balanced, but it's still a little bit off. So let's fix this by calling this, or identifying the difference, as the additional financing, or otherwise known as the discretionary financing, that is going to be needed. Okay, so the discretionary financing is going to be equal to the difference between the total assets and total liabilities and equity. So let's take total assets minus total liabilities and owner's equity. Okay, so we show up as our balance sheet is out of balance by approximately 3. So let's go in and subtract about 3. Rather than starting off with such a low number, when doing this on the homework, it's going to take a few more times going through the discretionary financing or this process. So let's start off with $424,610. Now notice that the discretionary financing is off by $35,400. If we just add $35,400, that is, let's see, it's going to be equal to about $460,000. But notice that that didn't work exactly. And the reason for that is because as we increased the level of debt, the interest expense on the income statement also increased, which then decreased the retained earnings, which caused what's called an iterative process. Okay, and so because of that, we need to take another run at this. Let's go ahead and type in 463,000 and see if that's fairly close. Oh, looks like we overshot it by just a little bit. So 462,500. And it looks like we need to add 462,510. And there we go. We were able to get the discretionary financing down to 0. So now this is not the amount of the discretionary financing. We just used that to zero in our balance sheet. And even in this case, it looks like our balance sheet is still off by just a touch, but we're going to call it good for now. But notice the amount of the discretionary financing is the difference between this year's or the projected long-term debt and our long-term debt of last year. So the discretionary financing is not 0 or 462,000. It's the difference between the 462,000 that's projected minus the 424,610. So the discretionary financing in this example is roughly about $40,000, and that will be enough to, number one, purchase the equipment that we're expected to purchase, as well as maintaining the balance sheet in this way based on the projected level of income from our pro forma income statement. So in conclusion, working through this iterative process is a little bit tricky, but I think after you do it a couple times, or after you go through this and work through it and then do it again on the homework, hopefully you'll get a little bit of a hang of it. In addition to that, one of the big picture concepts here is that as a business expands, going from $3.8 million to $4.3 million, it actually usually takes additional cash or additional financing needed as the business tends to expand. In addition to that, in our projections, notice that oftentimes we have certain relationships within the financial statements. And so in the case, or in this example, we specified that certain accounts had that certain relationship with sales, and we used that relationship with the projected level of sales to estimate the projected account balances for those particular items, such as the accounts receivable and the inventory, accounts payable, other current liabilities are just some of the examples. In addition to that, we can also say that certain accounts do not have this relationship with sales. They have other underlying factors, such as in the plant and equipment is based on plant purchases or sale of equipment. The accumulated depreciation is based upon where the company is at on the depreciation of existing equipment. Short-term notes payable and long-term debt, anytime you have a notes payable situation, that usually involves discretionary financing. You need to make specific efforts to arrange for that financing. However, accounts payable in this case would be spontaneous financing. It's financing that just kind of happens all on its own, which is kind of a neat concept as well. So I hope that this example here works out for you. And just one more comment here in regard to these formulas. Okay, notice in column F and G, I used what's called a helper formula. You could tie all of this formulation into a single cell and do away with the helper formulas, but I just find sometimes using these helper columns or helper cells for the calculations to help us see what's going on and help in understanding what's taking place in the process. So I know our authors didn't use these helper formulas, but I decided to use them just because I think it makes it a little more transparent in learning what's taking place. That concludes the Chapter 5 demonstration problem, and we'll see you again in Chapter 6.